Morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Today is Tuesday, the 21st of June, 2022. Just going to bring up the high-risk investment warning, and we'll bring up the commentaries disclaimer next. Thanks very much for joining me this morning, and it's Aneta, morning to you. Nice to have you in the webinar. And thanks everyone for joining so early. Hey Anna, morning to you. Here's our market commentaries disclaimer. I'll keep this on screen for a few moments. And our references: MarketScope 2.0, CNBC.com, and TradingView.com. I just want to keep an eye on our yield curve, the two tens. Just want to just keep watching that over the next period to see if we slip into inversion. And whilst this is on screen, I'm just going to go through the CNBC note, which headlines as European markets set to trend higher following positive global sentiment. European stocks are expected to open higher on Tuesday, continuing a recovery seen at the start of the week. The positive open for Europe comes as global markets appear to be staging a comeback rally after a tumultuous week last week. Asia Pacific markets were mostly buoyant overnight, and Bitcoin continued a recent rebound while US stock futures also rose. US markets were closed yesterday for the Juneteenth holiday. The rebound in positive sentiment comes after global market turbulence as investors assess the prospect of more aggressive Federal Reserve rate hikes and rising chances of recession. Last week, there was a flurry of central bank action with the Fed raising its benchmark funds rate by 75 basis points, its largest hike since 1994. The Bank of England also implemented its fifth rate rise in a row, and the European Central Bank also announced that it plans to create a new tool to tackle the risk of Eurozone fragmentation. There are no major earnings or data releases in Europe on Tuesday. Hey Derek, morning to you. Nice to have you on the webinar as always. All right, so we will go to the DAX in a moment. Just I think that it's worth keeping an eye on initial jobless claims now. So this is kind of a focus for us, I think. All right, so it's very difficult to kind of see what's going on here. So what you'll do is you'll just change this to logarithmic, just to get a better view of what's going on. This is weekly data, and what we are effectively trying to measure here is just how soft or hard the contraction is going to be. Okay, so I think a good way to measure this is we'll put on remember this is a weekly, so what we'll do is we'll put on a 12-week simple moving average just to get the 3-month moving average. Or just use a simple here. So let's just pop that in. And let's put that in here. As a 12, right? And then let's just make it a red line, a little bit more prominent. Yeah, that's good. All right, so we are above our 3-month moving average, and the moving average has, of course, has turned up. So the direction of the moving average here is also important. Okay, so it's not, so like over here we went above, right? So going back to sort of 2020, over here it it moved above, but the moving average slope remained horizontal. So the directional the direction of the moving average we're using as an extra filter, just to kind of filter how severe this jump up in initial claims is. Now, if we get below the moving average, clearly that's positive, right? But then we want the moving average to follow the direction down. So it's that extra filter. And we'll just keep an eye on the momentum here as well. Let's just put that in. So it is a weekly series. Doesn't matter if it was on daily or weekly, but I'll just put on weekly to avoid the confusion. Let's put in the stochastic. All right, and this to me is interesting. We want to see if it can drop out of this upper quintile. Okay. So I think that is something that we just need to keep an eye on. I'm just thinking here. There's an interesting. I'm not sure actually that the stochastic is appropriate here. I don't think it's appropriate, the stochastic. Just giving it some thought. I'll tell you why in a moment. Let's just put on an RSR. And what we'll do is we'll monitor this using the RSI. It's better. I'll tell you why in a moment. Let's just put a 50 in. So obviously I like the stochastic for momentum. It probably would work here. I've got to give it some thought. The problem with applying the stochastic here is that the high-low close, the high-low open close, all going to be the same figure. There's no range. You're given it's a line chart, right? It's not a bar chart. It's not a candlestick chart. So I've just got to think about this because the formula does specifically make references to highs and lows and closes, right? So for the time being, let's just keep an eye on this using the RSR, and we'll just use the 50 line as the dividing line. Anything above 50 would be a positive momentum. Anything below 50 would be a negative momentum. And let me just give some thought to whether the stochastic is appropriate. I'm thinking it's probably not. There's another employment number that we can look at. So what we don't want to look at, we don't want to look at the unemployment rate. The unemployment rate tends to lag, right? But initial claims or claims, unemployment claims is coincident. So this is initial. You've also got something called continuing claims. So these are initial claims. So let's just see if we can find continuing jobless claims. I don't think I've spelled right one. See, so this is another one. So this is after the initial. What's happening with the continuing claims? All right, so we can keep an eye on this as well. It doesn't look quite as severe. So let's just try and interpret why the continuing claims wouldn't have crossed above the moving average, but the initial claims have. And the idea here is, well, the unemployment rate is only now starting to deteriorate, right? So it's the initial unemployed which is starting to pick up because nobody is really continuing on jobless claims because the job market's been pretty good. So this would be sort of a confirmation of a deterioration in the unemployment, in the employment, a deterioration in employment. So we just want to see if we get a crossover here. So we don't quite have it on the continuing, but we certainly do set on the initial. So this is a metric we'll keep an eye on. And it's just asking, can I explain the rebound in positive sentiment comes after rising chances of a recession? Well, I think that let's bring up the DAX here. All right. So what we can see here, Anna, is of course a blue candlestick, right? You can see if we zoom in, here's your bounce in the DAX. We can take a look at a whole lot of instruments. We'll see blue here. Again, cryptos are an obvious candidate. Again, we're going to look at it more in depth tomorrow because of the compliance issues. So the question is, well, what's the rebound in positive sentiment as there is a rising chance of recession? So the answer to that, in my opinion, let's bring up Microsoft Paint, is the fact that markets don't move in a straight line. They're going to zig and zag. So we know that there's impulse moves up. We know there's correction moves down. And of course, same would be said to the downside. There'd be impulses move down, corrections to the up, impulses down, correction. So the idea here is we know that the markets don't move in a straight line. What becomes difficult, of course, is to pick the turning points, because you can only really see a turning point after the fact. So picking turning points is difficult, but the corrections are actually what we need to focus on now, because the media or the headlines or the news always has to kind of fit the narrative, or the narrative has to fit what's happening in the market, I beg your pardon. So if there's a bounce, well, you're going to look at the headlines and you're going to find out, well, why is there a bounce? So the headlines always kind of, the narrative always fit what's going on in the market. So it's very difficult to kind of get an accurate picture of what's going on, because the narrative's changing every day based on market movements. So what we want to do is we want to try and get an overall feeling and try and understand where are we in terms of the peaks and troughs. So that brings us back to the DAX here, and the question is, well, is this a rebound? Is this a rebound? Well, perhaps it's the start of a rebound, but it's way too early to say that, right? So let's kind of look at big picture here. Big picture is trend is down, lower peak, lower trough. That is down. We also know that trends are not going to unfold in a straight line. So assuming now, I don't know if the downtrend continues, we don't know, but if there is a continuation in the downtrend, it's not going to be in a straight line. It's going to zig and zag. So if it's going to zig and zag, then of course there are going to be rallies in the downtrend. But if there's rallies in the downtrend, what's the media headlines going to say? Well, they're going to say it's the risk sentiment is risk on, which it is, I guess, for the correction. But you know, it's very macro in terms of the macro. The macro here is that we're in a weak market. Any which way you want to kind of look at it, it's very difficult to not say that we're in a weak market. Have we passed the worst is a good question. And we won't know that. We don't know that. The reason we don't know that is because turning points we only really know after the fact. So then the next question is, well, why would there be a turning point if there is a rising chance of recession? So I would posit that the rising chances of a recession probably mean that rallies would be targeted. What we'd need to try and figure out, Anna, is if the chances of there would have to be a higher probability that we are avoiding a recession. There has to be some sort of higher. So I don't think that I don't think we need to get too concerned about the media headlines. I think that what we've got to try and do is find the media headlines talking about the primary trends, the fundamentals, not the day-to-day risk on, risk off, which again, it depends on your focus as a trader. Some people scalp the market. If there is risk on, they'll probably take the trades to the upside, and that's fair enough, as long as it's a tried and tested methodology. But the point is, I think that the probabilities of recession have increased substantially over last week. I think that is true, but I think that this is the trick. I think that the market priced that in before it happened. That's the contradiction. The market's forward-looking. It's always going to be. It's never going to look behind. So now the market's going to be forward-looking. How deep is this recession going to be? Have we over-discounted? Is it going to be shallow? Okay. Is there actually a chance that there is a soft landing? And that's what's going to be discounted. And then eventually that becomes obvious in the data. But by that time, the market's moved. The market's forward-looking. It will always be forward-looking. We have to be looking forward, not behind. So if we think that there is risk of contraction ahead of us, which I think there is, okay, subject to correction. It's my new favorite sort of add-on phrase. But I think there is a chance of a recession. Well, then I'm not so concerned about the contraction, the rallies, as much as I'm looking for the end of the rallies in the downtrend. You understand? So yeah, let everyone else buy here. That's fine. Assuming that there is still going to be another impulse down, I'm kind of going to be looking for this part. I'm not bottom picking here. I'm not good enough to bottom pick. I don't know where the bottom is. I would posit that nobody knows where the bottom is, just like nobody will know where the top is. But what I will be interested in is if we get something like this. Okay, so there I've missed the bottom. Okay, because this was clearly the bottom. But I'm only really turning bullish over here. So I'm quite happy to miss the bottom. I'm quite happy to miss the bottom because I think it's the safer option. And then I can try and figure out, well, all right, what's the reason that the primary trend has shifted up? Can't just do it in isolation. There has to be some sort of reason. The reasoning here would probably be that the Fed is engineering some sort of soft landing. I don't think it's possible, by the way, but let me change it. I don't think it's probable. It is possible, right? So if they manage to engineer some sort of soft landing, well, then maybe we do get this higher trough followed by a higher peak, and then that will make sort of an interesting analysis. But we're not there yet. We're certainly not there yet. If anything, we're at the point where resistance levels are extremely interesting, extremely compelling to short, because I'm not sure we've seen that capitulation yet, and if there is going to be if there's still going to be capitulation, well, it's all going to happen in bear market rallies. See, it's not the bear market that does the damage, it's the bear market rallies that do the damage, and that's always going to be the case. It's going to be the case when the next bear market hits us, and the one after that. It's the bear market rallies that are really going to do the damage. So the idea here is yeah, so Anna's saying, is the buying then possible for participants that are afraid to miss the bottom? There seems, so I think that there is maybe a compulsion to try and bottom pick. I'm not sure if compulsion's the right word. There is everybody tries to pick the bottom. Everybody tries to pick the bottom. It's very difficult not to talk about this without making reference to cryptos, because the crypto market is kind of your poster child for this type of discussion. Everybody's trying to pick the bottom of Bitcoin. Now, again, we're going to have to talk about it in more detail tomorrow, but the point is, I don't know if we've bottomed in Bitcoin. My guess is, and again, we'll do the analysis tomorrow, is that we haven't, okay? But the people that are trying to pick the bottom, assuming that we haven't reached the bottom, are in for a huge rude awakening, huge, right? And that's what, remember what we said, it's like trying to catch a falling fridge, right? So it's like trying to catch a falling fridge. So it can't be done. So you probably just need to focus, I think, on the top-down analysis, not the one time frame analysis. We take a look at this on the hourly time frame. It looks terrific. Look at the DAX on the hourly time frame. You know, if I only bought here, okay, there was a nice crossover signal. If I'd only seen this movement up here in the stochastic, you know, that would have been ideal. Look where the stochastic is now. So the stochastic's right in your upper quintile, and this is kind of would have been a beautiful buying opportunity. Well, you know, again, you're looking only at one time frame. Okay, top down, we're in downtrend. Okay, daily, you know, I'm just taking a look at this. Is looking so flimsy to me on the daily chart that I am exceptionally interested to see if resistance levels hold. Okay, look how flimsy this is. Now, I don't know if we're going from zone 3 to zone 2. We very well may be going from zone 3 to zone 2. In other words, this may be the bottom. It may be, I don't know. But, okay, what happens if we're going to stick around here, hey? And this is just your proverbial bounce in the downtrend. Well, we are in zone 3. We have got a low momentum reading. We have got a downtrend on a primary trend basis. Well, you know what? Whoever's buying over here, you know, I think you guys are wrong. You may be right. You may be smarter than me, but I reckon you're wrong. So I'm gonna short this given the opportunity, because that's just the trend on the higher time frames. And if I'm right, you know, I'll ride the impulse move down. If I'm wrong, I'll put a stop loss somewhere. Okay, I'll put a stop loss somewhere. I'm not guessing the bottom. I'm just working my system, because I know the system. I've used the system for a long time. I trust the system. I know that I have had a string of losses with the system. That's fine. Calculated. I'll take the losses, but you know, when I'm right, it works out nicely. So, well, what have we got here? 1, 2, 2, 3. Okay. Where does this 2, 3 end? And if it ends, is it exploitable? That's what I'm kind of looking at right now, right? Always use risk management, always use stop losses, because I don't know with any absolute authority. I am only applying probabilities, okay? So, and I am more than happy to take a controlled loss. That's what trading is all about, right? So Anna's saying, I'm still having difficulty with the concept of pricing things in ahead of time. Fair enough, and I understand that. We must accept that, because that is the key. We must know that markets are going to be discounting information. Everything is priced in ahead of time. Think about it like this, Anna. Think about it like this. Company A, okay, has a new product. Company A has a new product. It's a highly in demand product, and it's the only company that is making this product. Okay, we can, with a fair amount of certainty, anticipate that profits going forward are going to be pretty good, right? Now, what happens when company B comes into the market, produces the same in-demand good, but now has to capture market share from company A, and pricing strategies are introduced. Now, if you're an investor in company A, you've got to understand that going forward, the path is not quite as clear as it was, right? But it's not just you that's making that assessment, it's the entire market. It starts discounting the fact, well, now company A's got price competition. They will start measuring how much rivalry is there between company A, company B, how close are the products in terms of being substitute products. So you need to be one step ahead. And it's like that with every single market. We know that the dollar is being softened out of the market. We know that, okay? What happens, and as such, we've got to start positioning ourselves for that. What happens when the Fed starts reaching their target and starts slowing the softening of liquidity at the market? It's going to start anticipating that before the end. In other words, by the time the end comes, the discounting, discounting's already taken place. Does that have any sort of, does that help at all? We have to know that the market is information-based. It's information-based. All information is assimilated almost immediately into the markets, depending on how liquid the markets are. That's why a highly liquid market will be informationally efficient. Okay, so a perfect example would of course be the American, the UK, the Aussie, the Canadian stock markets. I mean, the information flow there is extremely good. And what happens when you go through to a frontier market? Let's say you go to a stock market, say in Ghana, okay? Well, the information flow is certainly not as streamlined as in the more developed markets. So there could be mispricings in the Ghanaian market. It's much more possible and likely that there are mispricings in the Ghanaian market as opposed to the industrialized markets. So the fact is, information flow is the discounting mechanism. In, say, the less liquid market, as soon as the information becomes available, that's when the discounting will take place. But that information may come later than in an efficient market. So now the obvious question is, well, which other markets don't have perfect information, and that there should be an answer that pops number one on the list. I'll give you a clue. We're going to talk about it tomorrow. Okay. All right, let's take a look at the, so now we've gone above R1. Okay, we've gone above R1. So the next level to keep an eye on is R2. So there does seem to be certainly a risk on type of feel to the market today. So if that is the case, how do we approach it? In my opinion, we take a look and see where is the primary trend. The primary trend is down. The zone is in the weak zone. The momentum is down. So then the R2, R3 levels become interesting. R3 in particular becomes interesting because there's a nice overlap here. Okay, so the risk on doesn't mean that there's going to be sort of an outright targeting by the shorts. The shorts they're smart people, right? So they could be putting in all their limit orders at R3. Now they're just waiting for the bids just to take it up to R3. So the order's probably getting just, for example, being placed at R3. There may be some being placed at R2, but there's probably a lot of limit orders at R3. And if there are, well, that's the discounting ahead of time, right? So if it hits R3, then what do? We wait to see if we get our triggers. We're always waiting. I don't know where the swings are going to end. That's why we use a trend following indicator and a momentum indicator. Remember, it's a dual trigger system. So we're trying to kind of match up the short-term signals based on the longer-term inferences. Now, if we move from zone 3 to zone 2, that would be a bullish step. If we get our stochastic moving towards 80, that would be bullish. If we get a higher trough, higher peak, that would be bullish. We don't have any of those yet. So because we don't have any of those yet, the resistance pivots become exceptionally interesting to me. All right. Does that make sense? Let's just take a look at the US dollar as well. All right, so the US dollar here, we've got the higher trough, higher peak. Okay, we've got the strong momentum. This is weekly. The daily chart is in zone 1. Okay, momentum has declined. So the dollar is sort of losing some steam here, but it is in zone 1. It is in higher trough, higher peak. I would just keep an eye on the support levels. Now, the support levels might not hold. We might get a capitulation all the way through. That's fine. I'm not personally not looking to short US dollar on my account, but sort of maybe R3 becomes interesting, and then I'll see if I get a bullish signal there and see if I can work with that based on the higher time frames. There's always top-down analysis. The lower time frame is always beholden to the higher time frames. We're always trying to do a top-down. And the reason we start off with the weekly is because it is very much a part of the fundamentals. It's driven by fundamentals. So what I'm trying to deal with now is the oil market. Oil market actually seems quite interesting. It's falling quite hard on the daily time frame, okay? But we're yet to give up the primary trend. See that? We're yet to give it up. So that makes it confusing. Now that this is confusing. So what's the deal? Well, I'd be much more comfortable if we had something like this, number one. Then we'd get a higher trough, higher peak. I'd also be much more comfortable if we get something like this. Lower peak, lower trough. But I'm always basing from the top down. Always from the top down. Always from the top down. Any questions, guys? Any questions? Let me know. All right. I didn't say, no. I didn't say short the US dollar. I definitely didn't say that. I said I'm not looking to short the US dollar. See, I said I'm not looking to short the US dollar. I just want to be very clear that, sorry if I said that, that's not what I meant. I'm not looking to short the US dollar. If anything, I'm looking for some support to come in. Okay, sorry about that, Rob. No, so I've got the higher trough, higher peak. I've got the zone 1, but I'm not looking to short, even though there's weakness coming in on the hourly. I'm not looking to short it. We're getting the crossovers here. We've got the crossover. This is all looking like it's heading down. The hourly time frame is beholden to the daily time frame. Daily time frame is beholden to the weekly time frame. Top down. I'm not doing a bottom up here. Top down. So and you can see here this S1 level at the moment looks like it's holding. If it doesn't hold, rather than sort of the S2 level, and I think that S3. So just like limit orders probably coming in for DAX, I would suggest limit orders probably coming in for the US dollar. Difference is these would be limit order, buy limit orders, as opposed to sell limit orders. So the idea here is top down, top down. Now, it's one other thing that we must just acknowledge is that we'll never nail the bottom or the top of the trends. Not with this methodology. There's no methodology that I can possibly think of where you can get consistently the high and the lows of the trend. And we've got to be okay with that. So let's just assume here, Rob, that this is the top of the US dollar. So again, this is just an assumption. So let's just say this is this top. Then obviously shorting here would be the right thing to do. But we don't know this is the top. So even though this probably would be a terrific shorting opportunity, assuming, which is just an assumption, this is the top, you know, we wouldn't be a part of that. Not with this methodology. We would need confirmation that the trend is down first. Once we've got confirmation that we're dealing with a down trend, then we can still do the top-down analysis. So we've got to be okay. We've got to be okay with the fact that we're never going to get in at the bottoms and the top. So if you are a long, you'll only know that there is an uptrend once you have the higher trough, higher peak. Once you're in, you won't know that the trend's changed until you have a lower peak, lower trough. So a 10 out of 10 would be between these areas here. So you've missed the bottom and you've missed the top, but you've got to be okay with the middle. Okay, so we're aiming for the middle. That's kind of our bread and butter. We'll never get the bottoms, we'll never get the tops. But what we'll try and do is we'll try and make sort of inferences based on COPOC that we are pretty close to turning around. But again, that's probably going to be late, and it's subject to whipsaw signals. So that's something that we'll do. But right now, I think that the likelihood of recession needs to be acknowledged, and I think the way that we analyze it going forward, we'll look at the initial jobless claims. Those are rising. We want to see if those now flow through into the continuing jobless claims. If that happens, I think that is a really negative signal, because that points to hard landing. So that's what we're going to try and do. And of course, we'll be looking at the yield curve to see if it inverts. It hasn't inverted yet, by the way. One point to make on that inversion: all recessions are preceded by inversions, which we don't really have yet. That's why we're looking at it. All inversions don't necessarily lead to recessions, but all recessions are preceded by inversions. So that's kind of what we're looking for at the moment. We don't have that inversion just yet. So let's just keep an eye on that. All right, guys, let's leave it there. And we will catch up tomorrow. Tomorrow we'll do the crypto market as well. Thanks very much, guys.